Well, we've seen very strong growth in the first half of the year, and the business has performed well across all its key measures. Earnings per share has grown a very impressive 13.3%, and the board's recommending an interim dividend of 9.5 pence, up around 8% on the year. In the UK, we're seeing growing consumer confidence. From the stats, you see footfall is up 1.2%, and sales are up 2% across our UK shopping centre portfolio. Importantly, we are continuing to outperform industry benchmarks. Group like-for-like net rental income increased by 2.1%, reflecting demand for the attractive, well-positioned space across our portfolio. We continue to focus on our active management strategy, and here we've introduced leading international brands, working with those retailers to develop new concepts and flagship stores such as the River Island Style Studio at Bullring. That demand has led to impressive ERV growth, up 3.3% in our UK shopping centres, and that's growing on the momentum that we earmarked at the year end. Well, there's no doubt that consumer confidence remains fragile in France and trading is challenging. But with our focus on managing the portfolio, we've seen encouraging progress at an operational level. Sales at our re-tenanted units are up 21% on average, and we have real focus on bringing in new international brands. We've also taken advantage of a very favourable and strong investment market and sold 2 of our less well-performing assets, recycling capital into extensions and future developments. Talking of which, our successful new scheme at Terrace du Port in Marseille continues to perform really well, and we've attracted over 1 million visitors per month since the opening. Looking forward, our future scheme at Beauvais remains on target for an opening this November. Well, we've made really good progress with our on-site and proposed developments, and we're on track to open 4 schemes this year. At Silverburn in Glasgow, we opened our new restaurant and leisure scheme in June, anchored by Cineworld, and we feature 11 new exciting restaurants, including TGI Fridays, Five Guys and Chimichanga. Looking ahead, we've got 3 further openings this year at Rugby, Merthyr Tydfil and Beauvais. And at Victoria Gate in Leeds, we continue to hit milestones as construction moves forward. Our John Lewis anchored development is going well, and we continue to negotiate good leases with some aspirational brands, including Mage and the White Company. Looking ahead, we're very excited about the income generation potential of our 3 major London schemes at Croydon, Brent Cross and Bishopsgate Goods Yard. And we continue to make good progress at each of these transformational developments. Well, with over £1 billion invested in premium outlets, this is a real competitive strength for Hammerson. And remember, we're the only listed European property company with any meaningful exposure to this high growth channel. In the portfolio, branded sales increased over 12% as a result of strong consumer demand, particularly from the ever-growing number of Chinese tourists to Europe. And our strategy to reposition the VIA outlets through remarketing and re-tenanting is already seeing results, reporting a 13% rise in sales densities during the first half. And with this sector demonstrating structural rather than cyclical growth characteristics, we remain very excited for the future. Well, we're continuing to target annual ERV growth uplifts of 2 to 3% and consistent earnings growth in the range of 6 to 8%. At the same time, we're maintaining focus on cutting costs, and our cost-income ratio is on track to hit 21% by 2016. Our development completions this year will continue to drive income growth in the portfolio. And with strengthening consumer confidence, footfall and sales right across our regional portfolio, we remain positive for the second half.